Hello and welcome to Big Deal. Let's put the spotlight on one sector which has been very abuzz on the M&A street when it comes to transactions, mergers and forming big companies. We're talking about media and entertainment space, which is very, very active right now on the deal street and also is going through a digital transformation. So to discuss all the areas which get affected because of deals and what lies ahead when it comes to the economics and the business sense, let me welcome on the show Nitin Chandalia of Boston Consulting Group and S.L. Narayanan of Sun Group. Gentlemen, so good to have you on CNBC-TV18. Now, S.L. Narayanan, first question to you. With big mergers and acquisitions happening in this particular space and with big competition getting created, how does a company like yours see the disruption in the space?
Thanks, Nisha. Thanks for having me on your show. See, as somebody said, the only thing constant in this life is change. And we've seen some amazing change over the last 10 to 12 years. I mean, I've been here for almost 13 years now. And every time it seemed like things are going to settle down, there's something or the other comes out of the woodwork and disrupts. My thoughts go back about a decade ago when some of the competitors who were not so present in south of India set up shop, and the apprehension was Sun TV stuff could get undermined. But nothing of that kind has happened. We need to evolve, innovate, and get on. So we are watching this space. It's a very, very important transaction that has been put through. We've also seen another transaction which looked like it was consummating, but somehow it didn't close the way it was anticipated. But we are very, very sure that we stick to our knitting and we focus on what we do best. And I think our numbers speak for ourselves. If you look at the last 10 years, our profit after tax has doubled. So even though our competitive positioning in major markets has been either constant or somewhat down, but then we need to, as management, we need to do whatever it takes, whether it's through professional sports or our motion picture business. We need to grow the top line and we need to defend our margins.
Right. So defend the financials. That's the big word really coming in from you. But when we talk about the sector, Nitin, S.L. Narayanan highlighted on one deal done and one deal undone. So the M&A thrust has been huge. How do you see this change, this disruption, and how do the dynamics of the sector change because of this?
So good afternoon, Nisha. Thank you for having me on this show, first of all, and it's great to be here, SL, along with you. Look, before we get into specific sector moves or sector consolidation, I think one of the things I wanted to call out is if you look at overall market in terms of advertising, the next 10 years or next decade, as we know, is India's decade. There is going to be significant consumption growth. And with that, the overall ad spend, which is currently at about 0.4% of GDP or so, is likely to continue to increase, should grow at a 1.5 times the GDP as typically we look at. So there is significant headroom for growth. Media overall as a space, media and entertainment is a space where we believe it's going to be an exciting space with a lot of growth opportunities for new players to come in, and so on. And market consolidation is a part of it. If I look at specifically from a consolidation standpoint, while consolidation does bring, some players together and make them meaningful, at the same time, India also is a fragmented market. There are different regions, there are different kinds of genres of properties which are out there. You have to look at Hindi, English GEC, Hindi GEC, regional, sports, movies, all of these separately. As advertisers look at allocating the ad dollars, there is a target around how to reach different segments, right? And therein lie the opportunity for a spectrum of players. For somebody like Sun, it continues to be relevant and significant opportunity going ahead.
Significant opportunity, and that's why there's just so much interest, especially also from global players and new players in India. So SL Narayanan, when we talk about the whole thrust towards consolidation, it also makes some very strong companies and fierce competition ensues in the sector. How do you think that the other players are going to tackle this, like yourselves? And also the positioning of the sector is such, the business model is such that one powerful company can really, the winner can take it all. What do you have to say about that?
Nisha, certainly, as a very thrifty and bottom line focused company, we will have to look at the whole landscape with great caution. Certainly, size brings in efficiencies of scale and the heft to buy content. That's all granted. But we have always, looked at content as an individual P&L item. I'll explain to you. There's one very hotly favored, show which I don't want to name names, but suffice it to say, a very premium property. At a certain price, it makes a lot of financial sense. Beyond a certain threshold, it's value destructive. And that's the reason why, we have been extremely careful with our content acquisition strategies. For instance, we have not spent any significant sums of money on web exclusives. But that has not impacted our positioning in the marketplace any bit. If anything, the company has become a lot more formidable. So there are certain segments, niches in the market, which can be served even if you're a smaller sized operator, and there is enough room for everybody to grow. So the way I see it is, we continue to focus on that part of the market segment where we can serve the audiences, but do so at a viable margin.
All right. So viable margin, when you said, SL, let me also pinpoint on the huge competition. So content is one very important area, and content acquisition is becoming the theme right now, especially on the digital and the OTT space. Now, Sun Next, your OTT, does not believe in buying exclusive content. So growth versus margin, how do you assess and balance the two, and especially in a very competitive environment?
Yeah, so no, I just need to qualify this. It's not like, we're not investing in content, but we're investing in the right kind of content, which continues to bring us the eyeballs, continues to, generate stickiness, and continues to deliver some reasonable margins. So if you look at our numbers, even though we have not invested in web exclusives, the kind of content investments that have gone into other parts of our business, including motion pictures. I mean, a movie like Jailer is something that involves a significant commitment of capital. But we are reasonably sure that a movie like that delivers a significant return on the investment, but more importantly, it generates IP which we can retain. I mean, if someone else makes that movie, we'll end up spending close to 100 crores buying the satellite rights or streaming rights. So if you have a strong balance sheet and the liquidity, I'd much rather create these assets myself, make a viable margin on that investment within 4 to 5 months, and retain the IP of the movie, which I can leverage for the next several years. Because please remember, unlike serials, which have a limited shelf life, movies have almost 2 to 3 decades.
Yes. All right. So you made your point there. And let me ask Nitin a twofold question. One is the cost of acquisition of content. How do you see that going ahead? And that has to be backed by some good subscription, people having the mindset to pay for entertainment. How do you see that develop? Because both will have to go hand in hand for the companies to really make profits here.
Right. So if you look at, how you get eyeballs for whether it's digital OTT or even on linear TV, right? Everybody needs tentpole properties. Now, tentpole properties can be reality shows, can be, sports. What we have seen that given the fragmentation in the market or the way the structure is, each of the channels, each of the broadcasting houses will look at ways to create these tentpole properties. As a quick example, if you look at how 10% of titles, for example, drive 80 to 90% of the searches for specific content online, right? So it's while we look at specific cost for a particular show, it's not just about whether you're making money on that particular show or a series, but it draws in the viewers and then it leads to discoverability of other kind of content. So content acquisition at an individual level, yes, needs to be seen with specific whether every content piece is profitable or not. But sometimes the added benefit of discoverability and getting people to platform becomes important, right? So companies will have to be judicious as to what are we spending for, and whether at individual level some may not make sense, some will. The second part, I think, structurally for this market, the amount of money that has gone into sports, right? We'll have to see how do you maximize or how do you get return on that capital, return on the money that's spent there. And hence, what amount of money are you committing or willing to commit to the other kind of content, whether it's, GEC, whether it's movie acquisition and so on. I think that's a part as we look at the market, profit maximization, or at least some focus on profit on linear and through linear while you are continuing to acquire customers or audience on the OTT side.
Right.
And finally, subscription will come to maybe as a subsequent question, but that's going to be an important part of the overall revenue question going forward if we have to look at long term.
All right. So there are many takeaways from what you said, and there are many questions regarding each one of them. Let me pick them piece by piece with SL. SL Narayanan, when we talk about subscription, is it now a similar kind of setup like the tax-paying citizens of India, that you keep overburdening the same small tax-based people? So because the people who are paying subscription are far lesser. What is your view and outlook on this?
Yeah, actually, here is the quandary for broadcasters. When you want to be everything to everybody and just doesn't work that way. Because there are certain people, like if you look at the 300 million homes in India, and my guess is about 160 million homes have either cable or DTH or free dish. These are extremely price-sensitive segments. I mean, I've seen, because I wear a different hat with Sun Direct, with a slight increase in pricing, we can see a massive churn. So especially in cable and DTH, the need to keep the value proposition attractive. I mean, that's a given there. So it becomes very difficult, therefore, to balance several conflicting parts of the equation and make sure that you stay relevant. And that's the reason why we focus on the linear TV with a laser-like focus.
Yes.
If 24 minutes of content creation is at a certain price, and I have 6 minutes or 360 seconds of airtime for selling ads, I need to make sure that these two parts are judiciously managed so that we continue to deliver a reasonable return on invested capital. And which then begs the question, is it really making sense for a broadcaster like Sun to spend big sums of money in producing a very, very big budget, 10 episode, season one of a fancy title, which we can premiere on Sundays? So if I spend 50 crores in shooting a 10-part season, I need to get at least 1 crore new subscribers to break even. And we are not at a stage where the market has matured to a point that people are going to pay top dollar to get high quality content.
Right. So we haven't really reached that stage, and that debate really rages on. That is the digital medium of entertainment going to overtake linear TV. We'll discuss more on that and more on what is needed in the sector in terms of even consolidation. Are we to see more of that? Nitin, SL Narayanan, hold your thoughts. We'll slip into a short breather and get back with more of those questions and interesting discussion right here on Big Deal.